Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you some trading levels for the upcoming week of October 23rd, 2023. What I'm going to do is I'm going to take a look at the major equity indexes, also take a glance at the bonds, and as well as two or three selected popular stock symbols. What I invite you to do is, as I'm going through this, actually pause the recording and take some screenshots. And you can then plot some of these levels in your platform and see how that squares with your view of the market in terms of how you select trading levels, and see how that kind of squares with your view of things. Also, when we're done, if you would give us a like and on in our YouTube channel, also subscribe to it. And then also, I'd be happy to talk to you about what you're about to see here. And so there'll be a link. You can actually schedule a call, a brief call with me, and I'd be happy to tell you more about what we do in terms of using what you're about to see to construct high probability trades. So that's the agenda here. Before I get going, obviously the usual disclaimer: Precision Trading Labs, we are not financial advisors or money managers. Everything we present is for informational and educational purposes only. All right, so here we are. We're looking at the SPY, which of course is the ETF of the S&P 500, the broad market index. So here's where we closed on Friday at 421 and change. And it's actually a very key level. You can see right here, this thing, price actually dipped below and closed below the 200-day simple moving average. That's kind of a big deal, both psychologically as well as from a technical perspective, as well as potentially algorithms kicking in. So it'll be very interesting to see when the futures open this Sunday night at 6 p.m. Eastern time, how the market responds to that. So this is a key level. We're actually also sitting at the lower daily Bollinger Band, the lower standard 2.0 standard deviation Bollinger Band. So there's kind of a confluence right here of the 200-day moving average, as well as that light blue line there. That's the lower Bollinger Band on the daily chart. So again, this is kind of a key level. So we'll look to see what happens here. Right below here, there is actually a daily demand zone here. Notice price comes down here, went sideways. It's kind of a pivot here also. It consolidated here for a day, and then notice then it kind of rockets out of there. This is what's referred to as a demand zone here. This is an area where there was an exhaustion of sellers, and essentially willing buyers ran up the price chart until they found willing sellers, and then that's how these trades all formed. So when price comes back here again, and you can see right here it's returned here again, when this gets here, there is a reasonable expectation we could see a bounce out of this level, which is approximately at 416 to 419. So we're right on the doorstep of that right here. There's actually a demand zone that it returned to here, but it looks like it's showing every sign that this is not going to hold here. There were 3 bearish days last week from Wednesday to Friday. So I don't necessarily know that this is going to really hold here, but this is kind of the same principle: drop, a base, and a rally here. Notice price consolidated and kind of popped from there. But again, when price returns here, this one does not seem to be, there seems to be a lot of downward price pressure here. So I'm not necessarily expecting this to hold. Right here, though, I think there is a reasonable expectation of that. And so we're right on the doorstep of that as well. After that, underneath, we have a level of support right here. You can see there were kind of multiple price, contacts here. It formed a base, came back, bounced out of here again. So this is kind of almost like tested demand here. So I think of it now as support. And then right here, this was also kind of an area of support right here. The next really clean area of demand is actually quite a bit ways below, and that's at around 400. And that, in terms of a percentage, you can see that's about a 5% move from where we are now to get to that. That's about, you can see about 21 S&P points. So that's the next area of kind of clean clean, untested demand, which is generally what we're looking for here. So in terms of demand, this is a summary here. Those areas of demand that I just pointed out, those are areas of expected upward price pressure. And then they're created, as I showed you just now, by a period of brief consolidation, then a clear, abrupt exhaustion of sellers. Okay. And then that exhaustion of sellers leads to essentially buyers running up the price chart until they encounter, levels where people are obviously willing to sell at. And then that is the basis for that. So when price returns here, we can actually, under the right circumstances and a high probability amount of the time, we will get a bounce here. Having said that, it doesn't always happen, and so naturally we have proper risk management in place. So that's what we kind of look for here. Once we have these levels, we can then express a trade in any number of ways. So for demand, which is what I was just talking about here, one could, of course, buy a stock. You obviously buy the symbol right here. And let's just say we're going to buy it at 419, which is the next level down. One could also buy a call, and you could buy a call obviously at the money at 419 or 420. You could also buy it in the money, and we typically what we'll do is we will actually put the strike price a bit behind the demand zone here. Because in a sense, we give the demand zone the chance to work. And so we'll typically put our expiration date, our strike price right behind here. And so that would be the basis of an in the money call. And then other ways we could express this trade, you could also do a bull call vertical debit spread, where you would then sell a call above. That would reduce the premium and also change the dynamics of the trade by lowering the delta on it because of the fact that there is an offsetting call that we sell above. And then also one could conceivably sell a bull put vertical credit spread in order to collect premium. And so one would essentially sell a put at the backside of the demand zone, and then buy a put further down. That lower strike put both defines and limits our risk, as opposed to just selling a naked put above. So what we do is, again, we sell a put down here, and that defines and controls our risk. So those are all different ways we can express the trade for the demand zone here. And then above here, if we actually did get a bounce, this would be at a level of supply here. And it's really the same narrative of the demand zone, of course, just turned on its head. So at that point then, for the supply zone here, we can see right here from the little note here, that's an area of expected downward price pressure when price returns here. This is also created by an exhaustion of buyers. Okay, and so essentially the sellers run down the price chart in order to find new willing buyers, and then that's how these trades got created here. So when price returns here, we can expect a fair percentage of the time that we will then get a repeat of the behavior from that led to the exit from this zone prior. Does it happen always? Of course not. This is trading. So again, what we do is we will have stops in place in order to control our risk. And typically what the trade would look like would be something like this. Here would be our entry at the front door of this zone. And then what we typically do is we would put our stop a short distance behind the back line of this supply zone. And so essentially this is kind of what the trade would look like. And so the range of this would be about 7 points on the S&P. That's actually kind of a chunk. It's a very expensive share. That's an expensive zone, and so that's one of the reasons that we really like to use options to express a trade, trading the SPY for that reason. So that's the narrative on the SPY. If we now move to the Qs. Here's where we are on the Qs. This is the S&P, the ETF of the Nasdaq 100, Nasdaq Composite. And so here was our close on Friday at basically 355, 354.5. And so this is where we kind of closed on Friday. Right here, there's a level of support immediately beneath, and we can just spread this out a little. We can see right here, price dropped, based here, rallied. Okay, it's now come back once here again, twice, really a third time here. So this is kind of a well-tested demand. So at that point, I don't think of this as really a good trading level anymore. But this is a level of support, but this is really kind of used up demand. And so really the next level down is this. This is a level down. This is a level that's probably like that appears in the 1 or 2 hour chart, and this represents a potential bounce point. And then in the daily, right down here, this is the next really clean level of daily supply. We can see that, and of course that's a long way down from here. That's about 27 points on the Qs. That takes you right down, from about 354 to 327, and that represents about a 7.5% move. So obviously, if one is rooting for the market, we're hoping we're not going to revisit this, because obviously 7.5% down is a pretty long way. That's the story with that. Right here, there's an area of resistance right here, and that's about 4% above here. If we actually did get a bounce out of the support level, this is an area of resistance right here. And then right up here, this is really the next area of clean supply. It actually did kiss the level very briefly here, but this was a very minor incursion. So the expectation is, and of course, if we got up here, you can see right here, that blue mark there, that line, that's the 52-week high. Okay. And so, we've obviously come down a fair ways from that. So our distance from that level here, that's about 7%. So you can see these levels of quality daily demand, they're each about 7% away from where we are now. We're kind of equidistant in between daily supply and demand here, as indicated by the percentages here. So that's where we are on the Qs. If we look at the TLT, which is the ETF of the 20-year plus bonds, of course, bonds are ugly, given the monetary policy that's been in place from the FOMC, the Federal Reserve. And so, the bonds are just in a swoon here. So I'm not looking as to be a hero to short to go long on the bonds here. But if we do happen to get a bounce right here, this is actually an area of daily supply right here. And if I just mark that up here, we can see right here, let me just blow this up. This is a rally, a base, and a drop. Okay, so when price comes, if price would rebound from here, this would be a great area to short from. Having said that, that's got to go about 4.5% to get there. So on the daily, in terms of a high quality daily level, though, that's what's there. One could conceivably short out of this thing as well, utilizing a lower time frame. But in terms of really the quality level, that's what we're looking at on the TLT. And again, to express that trade, what we do is we could obviously short the TLT here, as well as buy a put or do a bear put debit spread, or do a bear call vertical credit spread by selling premium. So those are all those ways of expressing the trade that I showed you earlier on the other chart, and that's just turning it on its head for a supply zone here. If we look at a couple of other symbols here, here's Apple. And so we're looking at the daily chart here of Apple. So here's where we were looking at. This is where this is actually this mark here is what we were looking at last week before doing this recording for the prior week. So we can see since then prices more or less dropped from here. We're now looking at this area right here of demand, and this is actually a fairly decent demand zone here. So that's we're right on the doorstep of that from right here. So that's right on the doorstep here. It's like less, it's a couple of points down. So we closed at 172.88. So this is at 172. So we're less than a point away from that. So we could very easily see this Monday. Above here, the area of quality supply is about 4% up here. Okay, and so that's where we are, where we closed here. And so if we rise about 7 points, that'll take us up to this 180 level. And so that's about a 4% move up here. This would be a good area to short from, or to express a bearish trade in the manner that I just explained a couple of minutes ago. So there's that for Apple. After that, below here, if this level would not hold, then this is the next area of demand below here, and that's about 5% down from here. But we're really going to look for to express a trade out of this level here. And again, though, the way that trade would look is this would be our entry point at the front door of the zone, and then we would place our place a stop a short distance behind the back line of that zone. Okay, so that's the deal with Apple. If we take a look at Amazon here, here's where we closed at 125. Up here, you can see more or less there's a pivot here. And if we could, particularly if we look at this in the 1 hour chart, we can kind of see very clearly there's a pop here, an area of consolidation, and then a drop from here. So this would be an area one could express a bearish trade over here. And that level is at, let me just turn on the labels here. So that's at around 133 and change to 134.5 or so. So, and we can see distance-wise, that's about 8. Having said that, that's about 8 points up and about 6.5% up. So, in the short term, this is not likely to trigger this week, given the state of given the sentiment of what we're looking at here. But you never know. But this is an area that I have marked out, and I have an alert set so that if price starts to rebound, this would be an area that I would then be looking for a bearish trade. In the 2 hour chart, there's an area right here, and that's about 3.5% down. And in fact, if I change this over to the 2 hour, slide this over a bit. So right here, here's an area of demand right here. So price came down, consolidated, and then we had this bullish move out. Price actually came back here, really kissed the level, just in a very tiny brief incursion. So this would have been a fantastic trade had one taken this, because it came really right back to the front line here and immediately left. We did not do this, sadly. But when price, but if Amazon comes back here again, we would expect that this level is still valid, because again, really virtually no demand has gotten chewed up from here. So, again, this is this very, very minor incursion here. So this is an area that we would look to express a bullish trade from. That's about 3.5% down. That's about 4.5 points down on the for Amazon. So that's what that chart looks like here. If we take a look at Google. So right here, we're sitting right above a daily demand zone of Google. And in fact, this actually kind of looks like, I think, the chart of Apple that we were just looking at before. If we go back here to the, in fact, let me take this back to the daily chart here. If you notice right there, there's that daily chart of Apple. Now, if we now go to Google, okay, we can really see we're more or less the same distance away. And we can really see it. We can actually see this in the daily chart as well. It actually looks a little cleaner in the 2 hour chart, but we can very clearly see though that there's a rally. Notice that indecisive candle here with that kind of doji look there. We're more or less open and closed at the same level, and notice then price rockets out of there. So this would be an area where we could express a bullish trade on Google. And that's sitting at around 136 to 134.5. That's where that level is. And then below that, of course, you can see this is an area of support that got created. And then, of course, way down, really the next clean area of demand is way the hell down here at 121. So again, if we're rooting for the market, we hope we're not going to be seeing that at any time soon. Take a quick look at Facebook or Meta. Haven't gotten used to that yet. At some point it'll happen. Looking at Meta here, again, really the same formation that we saw on both Apple and Google. It's kind of the same chart. Not the same chart, but the charts rhyme, as the expression goes. So here's where we are. We're right at the doorstep of this demand zone right here. And then after that, really there's really no clean demand underneath until really we get to kind of down here. This is an area where we were looking at it in the 2 hour chart. This was already a successful trade that we had a while back. And I just kind of left this up here just as a note. In the 2 hour chart, this was actually a nice demand zone here. So we can see price pop from here. After that, though, now really the next clean area of demand is about 11% down. And if we slide to the left here, we can see in the daily chart right there, there's a rally, a base, and a rally there. So that's the deal with Facebook. Excuse me, Meta. So at any rate, that's what I got. So I hope you guys found this useful and helpful. As I said, take a look at give us a like on our Facebook page. Also, and if you subscribe to our channel, and like I said, I would be actually very happy to talk to you and tell you about how we look at supply and demand in terms of creating high probability controlled risk trades. So this is Mitch Firestone. Thank you very much for the privilege of your time, and I will see you next time. Take care. Bye-bye.